Welcome to another Charts of the Week by ProActInvest.net for February 27th, 2012. I'm Rich Wiegand. We're going to be reviewing some interesting chart formations and developments in the financial markets. This week on the economic stats, not too much except for real GDP coming out on Wednesday and manufacturing on Thursday from Econo Day. It's a good source of economic statistics. As you can see, real GDP has actually been bouncing a little bit here, a little bit nudge up here. They're expecting real GDP to be somewhere between 2.5 and 3. 2.5 to 3.1% is better than nothing these days, so we'll take it, if we get it. On the earnings front, not too much going on. There's kind of a lull. The two main stories that have impacted the markets are impacting the markets these days would be the Iran nuclear compliance issue and the freezing of exports to European countries, which has in turn sent crude oil popping. Take a look at the chart. We see a long-term chart of crude oil. And as we can see, there's recently been this pop in response to the shutting off of supplies from Iran. The other major issue dominating markets over the recent days has been the G20 meeting of the IMF in Mexico City. Germany's finance minister, in the run-up to the meeting, suggested that increasing the size of the European Financial Stability Fund to a more significant size was in fact a good idea. There's talk that the Europeans are going to increase that firewall or backstop fund to as large as 750 billion euros, which is about $1 trillion US. The IMF gave Germany the message that it wants to see more affirmative coordination by the Europeans to raise some more capital first before they discuss extending credit lines. So you've seen, for instance, just today, the German Bundestag, which is like a parliament, approving an extension of their line of credit to address the Greek situation. And then tomorrow we'll see Holland and Finland voting as well. So we may see some more European countries over the coming days approving measures to increase lines of credit to help with the Greek situation. And then later on in March, there's going to be more IMF discussions about finalizing, credit lines together, coordinating multilateral discussions. So it should be interesting. But it is a positive development. They're acknowledging that something needs to be done, and they're going to address it. Along those lines, let's take a look at the FXE, which is the ETF for dollar-euro. The euro did back off a little bit from the news over the weekend, but as you can see, it's been fairly stable at around the 133 area. Long-term chart, you can see this is a monthly chart of the euro. It's sort of, hovering above this support level. We mentioned that the long-term support is still 126, but there appears to be resistance around the 136.50 area. You can see that maybe clearer on this chart. Okay, but the news is positive. It's not like the euro is selling off here. Any sort of doubt as to the commitment of the major European countries to stabilize the euro. Okay, in terms of the U.S. stock market, the Dow is within 0.12% of the target resistance level, 13,000. I've been mentioning this for a couple of weeks now, and the Dow has not managed to consummate the marriage so far. If it only would close above 13,000 at one point, then we can say, okay, the marriage has been consummated, but it hasn't thus far. I did a little summary of some of the key things that you can look at to help determine whether the market is attractive or not. I don't like to use the term fair value because I have no idea what the fair value of the stock market is, okay? If you have any sort of clue, let me know what it is. I'd be happy to listen to what you have to say, but there really isn't a very good, accurate way to determine fair value. All this is trying to do is give us an idea as to the overall tendencies. Okay, on the technical analysis side, the charts is still positive. We got positive breadth across the major indices. Moving averages positive, momentum positive. Only overbought, oversold RSI folks. And some of the Bollinger folks are maybe skeptical as to the longevity of this rally, but for the most part, in terms of the intermediate swing type of environment, we're still positive. The growth side of things, we got stable to up company earnings, and real GDP has been popping a little bit. Not great, but it's stable. In terms of valuations, this has been the longest period since 1973 that the stock market, the S&P, has hovered below its long-term median PE multiple average of 16.4. We're around 14 point something, and we've been around here for a while. So the point is that, on a valuation basis, in terms of PE multiples, the S&P is attractive to fairly valued, quote unquote. In terms of relative valuations, this is sometimes even more important than that PE multiple we were talking about. If we compare dividend yield of stocks versus treasuries, treasuries are yielding a negative real return. The chart here is a long-term chart of a weekly chart of TNX, which is 10-year treasury yield. We're hovering above the 1.8% floor here at 1.92%. My guess is that as soon as the European crisis is sort of, finalized, how to deal with the firewall situation with Greece and the peripheral Europe, then this yield is going to pop a little bit, because the safe haven argument for treasuries is going to sort of wane at that point, and we could see treasury yields above, 2.1% or so. So in terms of relative valuation, stock market is attractive as well. In terms of monetary policy, we mentioned this over the past few weeks. The Fed, as well as the European central banks, the Chinese, India, Brazil, they're all accommodative these days, which is very, very helpful when you consider that in terms of fiscal policy, the U.S. and the Europeans have to be very mindful of their budgets and not exceeding debt levels, as we've seen in this country last summer. It's a major issue for the United States as well. So on the fiscal front, very tight, low spending, so it's being offset by the Europeans and the Fed and the central banks of the world for the most part. So very positive accommodative policy there. Fiscal is a little negative. You put all of this together into one big pot of stew. You gotta admit that the market is still in an up mode here. The retailers came out with some pretty good results. Nordstrom's, that's reassuring for the overall market, but I have to say that I'm not a stock picker per se. I'm more of a sector guy myself. I like to use the ETFs and the indices. In terms of U.S. stocks and sectors, the ones that stand out to me are still technology, the cubes, and the emerging markets. Retailers are okay as well. But I would have to say that my overall favorite remains the cubes. You look at the long-term chart of the cubes, Fibonacci 50% retracement level is around 68.50. That's a good target level. We're currently at 64. Got the breakout that we mentioned a few weeks ago, and that seems to be a reasonable target to shoot for. The emerging markets as well looks interesting. Still, the emerging market stock index, it's struggling a little bit with this 44 resistance area, but the bonds, they have been rallying, as we mentioned, over the past few weeks. Emerging market bonds approaching the 114 area, EMB. I wouldn't be a heavy buyer at this point of EMB because of this resistance area. But if it breaks that, then, then it's a different story. RTH, with the robust sales that we've seen from Nordstrom's and JCPenney, Macy's, and Amazon, we could get a little bounce off of this support level into the 40s. This is definitely a breakout on the long-term chart, and it's commensurate with the strength in the retail sector of late. Okay, probably one of the weaker sectors would be IYT, which is the transportation index, and that's the flip side of the crude oil story that we mentioned earlier. Seems to be breaking out higher a little bit here in the face of the supply issues from Iran. Seems to be overhead resistance for XLE, XOI. Production suppliers got some overhead resistance around 14, 16 for XOI. Got a nice little breakout here. There could be some follow through, which is something to keep in mind as well. Okay, I'd just like to remind you that I put together a nice little video about convertible bonds in response to a question of one of my subscribers. It's on the ProActInvest.net YouTube channel. If you go there and you search for convertible bonds, I'm sure you'll see it under ProActInvest.net. So be sure to check it out and like it and subscribe and tell all your friends. And also, I'll be doing some more videos related more to long-term investors. I hope you look out for them. And, send me your questions and your feedback on them, because I'll give it my best shot, and I'll take a look at some of the issues that are very relevant to individual investors and long-term investors, not just traders on a week-to-week basis. I seem to be alternating these days between one video regarding weekly charts and then one video for longer-term investors and individual investors. So Here's another question that somebody asked me. I may cover this in the coming weeks. Which equity style box has the highest reward to risk ratio? That's a good question. But I'm sure you'll find this discussion on convertible bonds to be quite interesting. All right, well, that's it for this week. I hope you enjoyed this charts of the week for February 27th. And be sure to check out the video on YouTube and tell all your friends about the ProActInvest channel. Thank you for listening.